guys, welcome back. It's James Bennett here. This is the second part of this month's free educational series video on how to start property investing. And for those that you are new to my channel, I'm James Bennett, the property coach, and it's my mission to bring you up to scratch on all things property investing. Today we're going to be looking at a bit more detail on the property strategies that could potentially suit you best. When you first start out in property, you need a clear overview on all the property investment options what are out there. You need to think about what type of investment strategy suits you best, what fits your objectives the best, also your budget. We're going to be looking at the advantages and the disadvantages of the strategies and what one we think would suit you best. As I mentioned in the last video, we have a few different property investment strategies. We've got the traditional buy-to-let method. This is the most common property investment strategy out there, also known as vanilla buy-to-let. We have houses of multiple occupation. We also have holiday lets, also known as serviced accommodation. We then have the rent-to-rent strategy. So let's jump to it, guys. I'm going to break down each individual strategy for you so you've got a better understanding on what strategy you think is going to suit you best. So as I said before, buy-to-let property is the most common and traditional way to get into property investing. This is a model that's really simple and easy to start. This is simply purchasing a property and letting it out to individual family or a professional working tenant. Now the management side of running one of these properties is really easy. You can do it yourself. All you need to do is find one good tenant. The key to this strategy is being able to find a good tenant what lives in that property for years to come. You've also got to take the time referencing tenants when you're doing single buy-to-let properties. You're not going to be referencing people every day, so don't worry about spending the money and getting a professional referencing service to do it for you. Now, if we use a site called OpenRent, you can professionally reference tenants for as little as £20 and you'll have a turnaround within about 48 hours. So don't skimp on referencing tenants when you're doing single buy-to-let properties. Make sure you've got the target market in mind. Now, the average yield for a vanilla buy-to-let is round about 6 to 10%. So it's not going to make you rich off just one property, but no matter how big a property investor you are or how many properties you own, it's always best to have a collection of single buy-to-let properties in your portfolio. It gives you a good steady monthly income. Also, the good thing is about vanilla buy-to-let properties is that you are certainly going to benefit from capital appreciation of the property. It's most likely going to rise in value by around about 6% every year. So if you've had a property for 10 years, you know, it's just going to keep increasing in value year on year. So like I said before, it's a great way to secure long-term financial wealth. Whatever type of investor you are, it's a low risk and it's a traditional method. I personally recommend that all investors should hold at least one or two vanilla buy-to-let properties within their portfolio. So if you want a low risk property investing strategy, this one could certainly suit you. So what are the costs involved in doing a vanilla buy-to-let property? Now the costs in purchasing a vanilla buy-to-let property are, first of all, you're going to need a 25% deposit to put down on the property. So if you find a nice property and it's £100,000, you are going to need 25% deposit in order to put down on that property. You're also going to need the stamp and the legal costs of around about £2,500. Now you can expect to generate a rental income from this property of around 550 to maybe 600, £650 per month, something like that, in the Midlands where we're based. You're going to have expenses on that property also of around about £200 to £250. These will include the mortgage costs, insurance, etc. So for your £27,500 investment, you can expect an approximate £350 to £400 per calendar month of profit going into your bank. Now it's definitely not going to make you instantly rich, but with 10 of these properties it can definitely be a nice little retirement pot in the making. So like I said before, it's always advisable to hold some vanilla buy-to-let properties within your balanced property portfolio. But if you're looking to quit your job, your 9-to-5 job, and get into property investing, then maybe the vanilla buy-to-let route is not for you unless you've got £500,000 sitting in the bank. So what are the pros of doing a vanilla buy-to-let property investing? It's easy to understand, it's easy to get started. Mortgages for vanilla buy-to-lets are really easy to come by, so it's easy to leverage against vanilla buy-to-let properties. It takes up very little time in management. Also, it's dead easy to find a letting agent what would be able to manage the property on your terms. You've got predictable returns as long as you make allowances for costs, etc. So what are the negatives of the vanilla buy-to-let property investment? The returns are definitely not massive compared to the likes of rent-to-rent, HMO or serviced accommodation strategy. So this brings us to the next strategy, which is HMOs. Now, you might have heard a little bit about HMOs, you might have heard good things, you might have heard bad things. Well, HMO is basically a house share where a property is rented out on a room by room basis to unrelated individual peoples. There are different definitions of what makes a HMO, but that's basically it. Houses of multiple occupation. Renting out a property by room basis tends to generate a lot more revenue than if you was doing a standard single buy-to-let property. Now you could be doing a single buy-to-let property and generating around about £800 a month in rental, let's say. But a HMO is going to make you at least double that. HMOs always make a lot more positive cash flow than you would from a single buy-to-let property. So if you're looking to spend a bit more time and you've got a bit of a bigger initial investment, then you could consider purchasing a HMO property. However, they do have higher costs. HMOs tend to be fully furnished and you also have to include all of the bills. They are likely to incur more wear and tear on the property, so you might have to spend a little bit more on the maintenance of the property. Also, it's probably best you get these type of properties managed by a managing agent when you start growing, because each individual room is basically a tenancy all on its own, so the management side of things can definitely become a little bit more time consuming than if you're doing a standard single buy-to-let property. Even after all the costs, HMOs are always a higher yield, and as a result the HMO strategy has grown massively in popularities over the years. But the councils have now cottoned onto this and have started regulating HMOs. They're basically tightening up the regulations. In certain areas they're even refusing permission to convert standard properties into HMO properties by introducing things like Article 4 regulations. So what are the good things about HMOs? They've definitely got higher yields than single let properties. if one of your tenants stops paying, you're still generating an income from all the other rooms what are within the property. Same if one of the rooms was empty, you're still getting rent from all the other rooms. Now if you've got a single buy-to-let property and somebody stops paying, you lose all of your rental income. But when it's a HMO, you're still generating income, so they're not as risky as you might think. What are the drawbacks of a HMO? Now there is definitely more management required to a HMO, as I have just explained to you. There's definitely more regulations. You need fire strips around the doors. You've got to have wired in smoke alarms. You've also got to have fire blankets in the kitchen, etc. There's a few more risk assessments you need to undertake when you are doing a HMO. And also it's worth mentioning, if you're trying to use a mortgage to get a HMO, HMO mortgages are a lot harder to come by than standard single buy-to-let mortgages, and 9 times out of 10 the mortgage company is going to want you to have some sort of portfolio before you dive into getting a HMO. So HMOs are not always a good way to start out when you first start off in property investing if you are using a mortgage. Different if you're using the rent-to-rent scenario, because you don't rely on mortgages and everything happens pretty quickly. So the other strategy, we've got holiday let